Okay, what is going on? Don't you love working all day on a Saturday after working every single hour of the week? It's just awesome. Um, but I'm trying to build businesses as well as work at the same time, so this is what happens. Um, anyway, let's get to it here. It's smarthelping.com, and I've built an account executive driven financial model, 5 years. And so this is not an industry specific model, but it's specific to any business that has account executives that are basically the solely responsible for generating revenue. Getting clients, maintaining clients, helping out with marketing initiatives, whatever. Basically, you're assuming all the revenue you get is driven on a per account executive basis. And that's the bottom up part of this model. There's also some top down logic. For example, cost of goods sold is just going to be a percentage of revenue. Same with marketing, an actual specific marketing expense. Um, then you have more bottom up with CEO salaries. You'll be defining all those executive salaries, rent, office supplies, legal, all that stuff's just you'll determine that, and it could change on an annual basis. So that's the premise of this model. I've added an index, make it easy, defining all the main terms that you might not understand or know right off the bat in the model, and then a simple instruction that shows what each tab here kind of does. Then we have more in-depth instruction and general overview. You know, edit all cells in this shade only. Don't touch anything else if you don't want to mess up the calculations. And then just general instructions, point by point, on all the major things that you need to understand about what's going on. So once you've read through all that, you'll have the business overview. I've tried to really get the structure this in the best way that shows you immediately what you want to see, and then drills down from there. So right at the top, we've got months to break even, leveraged, non-leveraged, discounted cash flow valuation, financing amount if any, internal rate of return after tax. This model does include assumptions about corporate tax rate and cash flow after that. So it's really drilling down to try to give you an example of what the amount of capital you put in is and what the actual capital you get back out is with all these different things going on. So leveraged and non-leveraged, internal rate of return, percentage of debt and equity. This only applies to obviously the scenario of leveraged. So that's why this 11,500,000 is different than the net leveraged, non-leveraged equity requirement of 11,003. And obviously the only difference here between the equity requirement and the leveraged total amount, obviously the 5 million would be this, which changes with that. Oops. And then the equity would be the amount of capital that's required given all the assumptions, assuming you're getting this much in finance. You're saying, well, you still need this much more to actually survive. And so that's that total. So that total is only going to be different from the non-leverage based on the amount financed plus the negative cash flows. So if we go into our monthly real quick, and it's jumping ahead, but just to show you how that works. Let's see here. There is just so much logic here. Right. I don't know why I was thinking that was so different. So yeah, that is. So three. So the difference there, the difference is not going to be the total financing amount. It's simply the difference of this in this total is going to be the difference of the debt service while having a negative cash flow. So 171,000 here. And that's it. You see 11, if we do rough math, 171 plus the non-leveraged, you'll get 472. Yeah, so that's, if I did the exact math there, whatever it was, that would be that number. So there is not too much of a difference there because the debt service usually isn't that much in the first, 12 months or so, but still you can see how it is different. And then we've got our 5-year cash return less debt, and that is also doing including tax effects of paying taxes on profitable years. And you can control the tax rate that you want, or you can put 0 if you don't want to show a tax effect at all. We've got, so let's see, you saw IRR, EBITDA, I'll go into that more, break-even month, debt and equity. So this is just if you're going to finance, you've got to put this much of your own money into it or get this some amount from investors. If that's the amount you're financing, total amount there. So now we're here, this kind of breaks down leverage versus non-leveraged. So the 7473 is just this number, and it's saying if you do have financing, then the difference, again, the difference of these two is going to be the amount financed to 4 million plus that difference in cash flow variances because of that service. So if you do finance, well, you don't have to put as much money up front, but you can see you're not going to get as much money back over the 5 years because you got to pay debt service. So the ROI here is higher in this case for leverage because you're putting less cash in, but the actual cash you're getting back would be higher when you don't borrow. And then the amount that's going to be higher by, I know we're getting deep into the woods here, but it's 4,754, 4,754,000, which should be equal to the amount you're financing. And then the 754 should be the debt service over the term. Let's just go to the annual so it's quicker to add up. This is 1 million. There's a lot of stuff going on here. Oh, I'm going to talk about the discounted, how you actually figure out the internal rate of return, how it's being calculated. That's actually pretty interesting. But first, so what's the 754? Might have to go to the monthly. Let's see, what's the debt service after negative cash flows? 973. Let me see here. There's so a lot of logic going on, and really, it's not that important. The most important part of this, the biggest part of this model is the fact that you get to drive account executive assumptions. Let's see. That's where, okay. This leverage is assuming you're paying back the loan as well. So it's doing your net leveraged position at the end of the 5th year. So it's saying at the end of the 5 years, okay, you've got this much cash back, but you also still have this much debt. So if you pay back that debt, this is your cash flow. And you can see the debt balance, 3,600,000, and then that makes sense because if we do 3,600,000, got it. Difference between these two would be paying back the debt plus the debt service. Alright, that makes sense, I think. So if we do this minus this, 4763, and then I think the difference of these two is 9,000. There could be a debt, something going on with the tax rates or some kind of a debt something, but that's the calculation, how you get back into it. Let's see, 9,456. Just trying to think what that could be. It's going to be tough. You have to go through, but I'm sure it's correct because it's all tied out and all balances. But it's something. It's something here. So again, you have to pay back the debt. So it's saying your return on investment is the amount of money you put out less the amount of money you have net of debt and net of tax effects. And there it is. And obviously I put in a huge case here where there's account executives, you know, it's a perfect situation where you hire and they always meet their quotas. Obviously that's not going to be the case, and you can adjust for that, but just for the purposes of showing logic, I've put it in like that, and to make it smooth, the charts look smoother. Your case could be completely different, it doesn't matter. The point is that you can build whatever you want to articulate. So there's ROIs. We have just a general profit and loss. You know, you've got revenue, cost of goods sold, gross profit, general administrative, R&D, sales and marketing, other variable costs, total expenses, EBITDA. Then we've got things like debt service, taxable income, corporate tax rate, cash flow after taxes. Then you've got your debt service, then net cash flow after taxes, and then you've got one-time expenses down here. And then net cash flow after all, which I've dubbed the term. It was just the easiest way to write it. So net cash flow after all, 300 million. Running cash position. You can see that it equals the sum of these cash flows. 301 million, 301. We've got account executive metrics. Now this was interesting. You can actually see the average revenue per account executive and the average account executive salary, and then the gross that each one's bringing in per year on average. Cumulative cash flow as a chart. The 5-year plan cost by category. So you can see all the costs that are going to happen over the 5 years. Here's the totals of them, and this automatically populates in order of highest to least from cost of goods sold, corporate income tax, sales, marketing, G&A. So you've got that there, and the pie chart shows the percentages of each deal breakdown. That's just flows up to the top. We've also got cash outflows by year. So this is showing the totals of each category by year instead of just in the pie chart the whole 5 years. And you can see, because I made it smooth, this obviously the last year as cost of goods sold is the highest, and it goes down from there, and that's like the biggest point. But you know, who knows what your scenario may look like. The last chart on the business overview is the leverage cash position versus debt owed. So this is kind of ties into back to the top here where I was talking about the difference between your actual debt and debt owed and actual cash accumulated. So it's not, let's adjust some things here. We'll make this a lot easier, and I actually want to start here anyway. So let's clear this off. So this is assuming no account executives. We go back to the overview now. It's obviously all debt and losses. As you can see, let's put in, and this is really the focus. This model, all the charts and the valuations and the breakdowns of all that's pretty standard. I've just tried to make it look really nice. But the main meat of this model is the ability of you to use this tab right here. So you have 3 types of account executives. These types of account executives also have different base salaries and possibly different bonuses. I'd put them all to flat bonus of 0.5. They also See if I can get this. I don't want to lose the comment. Oh, it didn't have a comment. They also have a quota. So that's how much you expect that type of account executive to make for the company every year. And this is the 100%. Now, here's where it gets interesting. You can forecast how effective your account executive is by quarter. So let's just do this. So let's say we got account executive type 1 first month. Let's say we hire one. We're saying, let's just say 0% effective the first 90 days. So they're going to create no revenue the first 90 days. Then we say they're going to be 25% effective after that. So we've got a 25% effectiveness. If you take 25% times a million, they're at 250,000. Then do a monthly basis. It's 20,833. That's where we get that 20,000. And it's all dynamic, all changes with all the numbers. Say if I put this in half, that about cuts in half. If I doubled it, it doubles. And that's it. So that kind of shows you the revenue. But here's where it gets interesting. Let's say we didn't start that account executive until March. Well, now if we start in March, we don't have revenue coming in until June because, well, the first 3 months we still have it at 0%, and then this model is smart enough to know that in the 6th month is actually the 4th month that this account executive has been active. So it starts the process there. Now let's get even more complicated and say we add another account executive the next month. So now we have a total of 2. However, that account executive is not going to get active until all the way over to July. But we still have the first account executive that's going to be active in June. So look at what this does. And this is moduled out for all 3 types. Look at this. So you got the first one, 1, 2, 3, and then it hops up to the next percentage. Then you got the next one starting the next month, but it's still not going to increase until it gets to its 4th month. And then it goes on from there until they're fully effective at 83,000, which is after the 4th quarter of the start of their 4th quarter and forward. So we are making the assumption that by the time you get to 100%, or by the time you get to the 4th quarter, they're going to be 100% effective at whatever their quota is. And you're assuming everybody you add is going to be added in perpetuity and make this. Now you could, if you want to say, well, you know, certain account executives will never reach their quota. Well, you could either lower their quota or just lower the percentage and say they'll never get to it. But this allows you, the way I've structured that, I've just showed you the logic. You can now do that. You know, we can add this at all. That's the first one. Here's the second one. And there's the third one. At 5 million quota, you see those numbers get bigger. 400,000 by the 4th quarter. It looks like 1, 2, 3. Yep, 400,000. And the reason why this is important is because you can play around with all these numbers, and if you start adding, say, 1 of each type a month you're ramping up here, and then you don't add any more. It still tracks. You've got 15, and then look at how cool this looks. It scales based on how long it takes them to become, reach their quota performance, and then goes out for the 5 years. And because the reason why this is important is because you generally have all these different things happening all at once. So it's hard to aggregate what all the stuff into each month and what is actually supposed to happen each month with all these different logical scenarios. So that's what, by modulating it out, building 3 account executive type modules. With all that logic, I can simply look at each month and just aggregate the total revenue generated for each one. And now, in my total revenue from each AE, this number is correct in adding up all the numbers. And we eventually, when we get to full capacity, it's 3.3 million a month. But up until full capacity, we have all these interesting numbers here based on the logic of how active people get and how many account executive types we've added each month. And this could be more. You could do 2, 5, 0, whatever. I think this is the most innovative revenue logic I've done for any business that has account executives, and that's a lot of businesses types. So there is that. Now if we go back, now you will understand a little bit more about what this means. So I'm showing you the average revenue per AE, and because that's a dynamic number, we just have to take the total revenue generated for the year divided by the total AEs for the year, and then they all have to be paid, so you've got an average salary, and then the differences are margins. Now if I say, this is super, 75%, 90%, 90%. Let's say we're going to pay them more. Pay these 250,000 base salary, 0.5% bonus. Let's pay these 175, but give them 5% bonus, and let's pay these guys, say, 800,000 and a 2% bonus. If I do that, let's go look at our margins now. A little bit lower, 50%, 80%, 82%. So they've come down a bit, and that's going to affect, obviously, all the cash flows and then the EBITDA. But there's how you can play with this, and that's why it's so crucial to build whatever case you plan on doing. And it's dynamic, super dynamic. So we've got all of that logic. I'm trying to explain it the best I can. There's just a lot of stuff to explain. I really want to capture all the great stuff that this model can do for you. Alright, so we've got the Account Executive Builder tab. We know where that's flowing into. Let's go to the operating costs. So this is the second tab. And by the way, you'll basically have 4 tabs where you're inputting information. The business overview, which you just put the financing information and the date and the reserve if applicable. Or you could put 0 and then just assume this, you're going to do exactly what you project, and then that's your equity requirements here and here. But let's put that up to 500,000. And all that's saying is 500,000 based on whatever you projected. It's giving you another $500,000 of space on your capital requirements. So you see that's 12,617. If I put that to 0, 12,117. So that's all it's doing, and that is affecting all the returns as well. Anyway, so you put in these inputs: reserve, financing, if any, date, and then you go to these tabs. So you got your account executive, which I just explained. And by the way, you can change the time it takes to get to 100%. You could say make this month 25. So now it's going to take 25 months for anybody to be fully effective. And again, that would affect all. You see these cash flows went down. But that you can play with these months. These are the months that trigger each change of effectiveness. We'll put it back to 10 for now. So operating costs, this is just, your CEO, CTO, COO. The start month, you plan on those costs happening, and then the monthly costs of each of them. And then the monthly costs may change every year, so you could change it by year. I've totaled up some totals here. Basically, you see your total burn on that, your total variable burn, which is cost of goods sold, marketing, any other fees, and sales tax, and that again is dynamic. If you put in, say, March of 18 here on the cost of goods sold, we shouldn't see cost of goods sold until March, and we don't. Perfect. Let's check the other two, make sure. So if we put these over to, let's say, May, June, April, so that's marketing, other fees, and sales tax. Marketing, Perfect. So May, and the other one's 0 across the board because I didn't put anything in, any percentage in for it. May. Other fees as a percentage of revenue should be 1%. Where's that? Oh, here. That's the 1%. That's at May. Oh, hold on. Go back there. Let's double check this one. Go to November. If operating costs, let's see what is my logic here. Operating cost C53. I might have. Yes, I did. So change it. So that needs to be C54. No problem. Because I've already changed the lookup to row 54. Now we'll see that. There we go. Now it doesn't start until November, which is what I just set it to. Let's check the other ones real quick. Sales tax 53. Sales tax should be 55, and that's, I think, when I added these rows in for totals, it messed up. So 55 is sales tax. Luckily, the H lookup switched with it. Let's just make sure that works. So we'll put in a 1% here for sales tax. Let's put in 1.5, just so it's different than that one. And there we go, 50,000, and it's starting in April. That's what I got there. So that's working now. Let's double check the marketing. 53, yep, that's working. So 53, 54, 55, perfect. And then this is going to 53.49, 54.50, 55.51. Get rid of these div errors. Okay. So those are that's those costs. You can switch these, and this is why I go through the model to make sure everything's working in front of you guys. Income tax. Then we have one-time project costs. So this is if you have a cost. Right now we've got February 250,000 going out. So if you go to February of 2020, one-time cost, there it is, 250, and these are all dynamic. And that is costs of just one-timers, like furniture upgrades, R&D, and I haven't included much of those. Those are not included in the tax deductions, so I haven't deducted them when trying to figure out what the taxable income is. Just for broader purposes, that's probably going to be more accurate than the latter, but either way, the most important part of this, which is the cash flows, is going to be on point. And even before that, you're going to easily see revenues, cost of goods sold, R&D, all this. Your EBITDA is not going to be affected by that whatsoever, which is the most important thing, really. Alright, so there's your operating costs, startup costs. Startup costs, you just put in anything that you plan on having to expend to get the business started. So, building, construction, showroom, just any costs that go out before you're starting to get revenues. And then that's it. That's pretty much it. There's the monthly P&L. I've done a quarterly, which does the same thing, but quarterly, and then yeah, these just sum up, so I don't need to change any of these formulas. And then I did the annual roll-up here. and it shows you all the different pieces of the puzzle for the annual. And then you got your debt schedule here, which you could change all the different terms. Make that black. And then this is pulling from the business overview tab. And then there's your schedule of debt, which automatically rolls into all the applicable parts of the model to come up with the right calculations for, you know, current debt balance and interest payments, debt service coverage. Alright, so that's all of that stuff. What else can we do here? Break even. This is just showing this is your variable cost. This is your fixed every year. So you got to make this amount of revenue just to break even given these assumptions. This is your monthly break even. This is like a running cash balance, saying, you know, based on your startup costs and the cash flow you plan on making, how many months does it take to recover those initial startup costs? And it'll be different for leverage non-leverage because that results in different cash outlays at the beginning as well as debt service payments throughout. Valuation, this is just a 5-year discounted cash flow. You got your discount rate. You can choose if you want to value your business at the end of the 5th year based on the EBITDA multiple or revenue multiple, or you can put 0 if you don't want to take into account the fact that you're selling anything and just value the future cash flows. 25% discount we got here, and based on that, the net cash flow before debt service is this, and coming from F77 on the annual right here. So based on that, you get a discount, and then here's your enterprise discounted cash flow value. Now if I put a value into here, that increases. There's your terminal value, which is just if it's revenue multiple, it's taking the revenue figure. It's taking the revenue figure. If it's an EBITDA, it's taking the EBITDA and doing the multiple, whichever one you define. So at this point, it's saying revenue multiple of 1, so it's valuing your business at whatever revenue, 40 million. If we put a EBITDA multiple in there, it's doing 1 of the EBITDA multiple of 19, so 19, and then you're just discounting that value back 5 years based on the discount rate. Now I also put in a cash requirement here of non-leverage. So based on no financing, this is the amount of cash that you're going to need to get this thing off the ground. And then this is the value of the future cash inflow from that. And that's before any debt services. So this is just basically, this is just taking into account the one-time expenses, the EBITDA, and that's it. Right, 177. Let's see. Let's do an EBITDA minus any one-time expenses. Perfect. Yep. And then we have more charts. So here's your margins. We got gross profit margin, EBITDA margin. Then we've got your running pre-tax cash positions, leveraged and non-leveraged. They're basically both going to be the same curve, just one's going to be a little bit smaller than the other based on, you know, the non-leverage. It's going to take a little bit longer to break even since you have more cash coming out. Total account executives. Now this looks a little bit, and here's the average revenue per account executive per month. Now these charts look a little bit better when we just do a smooth, say we hire one of type 1 and 2 every month till 2021. You can see these curves get a little bit more interesting here. Total AEs. So I guess that's it. I'm trying to think of anything else I want to explain. Let's say we don't have a financing amount or a reserve, and you're going to not have any revenue. Until July, and then you hire 2. Now, so what are your you basically for these first first 6 months here, it's still going to apply based on the start months and the amounts. It's going to apply these costs. If we go, let's make sure. So the CEO one is lagged behind. Perfect, that's working. So assuming these costs happen when you say they're going to happen, this is all going to be burn, and because of that, it's going to flow right into your capital requirements, and it's not offset with any revenue if there is no revenue, obviously. So that's how your capital requirements dynamically change. So here it's 12.2 million. Let's say we have revenue starting 1 month earlier. Your new capital requirement is now 11.8. So it's going to be lower if you hire more AEs and those AEs are producing revenue instead of nothing's happening. But that's a real simple way to use it. Is you simply try to plan out your burn costs, your burn items, and then figure out when you plan on starting your AEs and when they're going to be effective, and that kind of gives you a better runway for scaling. And then you can scale it however you want. I'm trying to think how I want the default to be. I think we're going to go 111 every month just to show it looks cool. And then let's do effectiveness. Let's actually only do 10, 0 the first quarter, and then 25, and then 100. But then let's lower this account quota to 750. Now let's see, this should look a little bit more realistic here. Cash requirements 18 million. Because our startup costs are 10. And no debt coverage. Yeah, we got a pretty big net deficit there because we're not covering all the costs. What's our EBITDA looking like? 5 million, 2 million. And what are we have? Do we have no debt in this case? Oh, that's the running cash position. So yeah, 5.2. Then we get positive here. Oh, I almost forgot. So I wanted to explain internal rate of return a little bit better to people who want to know more about that. So let's just look at the internal rate of return non-leveraged after tax. So say it's 21%. So what does that 21% mean? Well, it means if we go to the cash flows it's representing, which is, what was it? Non-leveraged. If we apply that percent to the future cash flows here, end up being 20 million. Well, if we discount it by that internal rate of return, look at what it equals: 18,770,583. What does that equal? The capital requirement. So your internal rate of return is just the percent that you have to discount these cash flows by, so that they equal what your capital outlay is. Based on that, your net present value is 0, because if you put this much cash out and you value your future cash flows at that IRR percentage, or if you discount them at that IRR percentage, they will equal this amount. And obviously the bigger these cash flows are, the higher you have to discount them to equal your starting amount. So that's why high IRR is good. So that was cool, and I put the proofs in here so you can see it's 18,770,000. If we put in some debt here, let's say we put in $5 million of debt. Now they're a little bit different. The leverage, you only need 14 million because you're financing some of it. 14,258,000. So discounting these future cash flows. So very interesting. And here's the other cool thing. With the leverage, this is assuming you're borrowing the 5 million here. So if you go into your monthly, your only startup costs are going to be that initial cash requirement. Let's see here. There'll be the cash requirement, which is just the minimum running cash balance of the monthly. So this saying, and on a month-to-month basis, how low does it get? Because you're going to need your 10 million initially. This is how much you need. I'm sorry. The leverage. I think we're. Yeah, the leverage version. So saying 14.2. So it's saying you're borrowing 5 million, and you need 10 million to get the startup cost. So that means you borrow 5, you pay 5 to this, you still have to come up with a 5. So your initial cash outlay is 5 million. But you're also losing 142,000, 142,000 these month, 248. So your actually cash requirement is going to be this 5 million plus all these net losses on a monthly basis until you start to go positive. So it's adding 9 million to the 5, and if you just sum up the whole thing, you get 14,258,000, which is this number right here, which is the minimum of the entire running leveraged position. So all I have is a formula pulling the minimum here, and whatever that is your cash requirement, because that's how much cash you have to come up with to cover these costs. And that adjusts. So you see the leverage position is going to be just basically 5 million more plus the debt coverage that we already went over in the beginning. And this, let's see, when that starts to go positive, you hit a max. So 770 is the max. Then you see start to have positive monthly cash flows here. So you have to at least come up with 18,770,000, or else you're gonna go bankrupt, or you're not going to be able to cover all the expenses. So that's why the capital requirement is going to be so important, because obviously you're not going to be right out of the gate making a ton of money. Now this could be modified, and it could be a different if you're not a startup. If you're running a business, you've been running for however many years, but you want to predict or project out the next 5 years what's going to happen, then you might not have any startup costs, because let's say you don't borrow anything and you already are making revenue right now. In that case, hold on, let's say I just want to make it a really clear point that you're not going to have to start up. Put this at 0. Still got 13 million in there. I'm just trying to see what's causing this. Why is this 0? Stand by 1 second. Okay, I got lost in the woods myself here. I put 0% for Q1, so no matter when they start, obviously Q1 not having anything. So let me just put this at, like, let's just just for the sake of, I want to show you what it's like if you're not going to have any debt at the or not going to have any startup costs. Still 3 million. All right. Let's assume none of these costs start until the following year. Okay, now what are you looking like? Still 2 million. What is going on here? EBITDA is still negative. Yep. Alright, we need more revenue. Oh, here, this is probably one reason why we've got a ton of salary here. Let's just say they're 100,000 each. Because that's scaling as we add these more AEs in here. Okay, now that's what I was talking about. So we got errors in the internal rate of return. Let me adjust this so. So that's because you have no negative cash requirements. So you're valuing it at 133 million. Your return is 168, and that's all you're doing. And then you still got all these metrics. But look at no debt, because you're not projecting any debt. So you've got no debt service, none of that stuff. And you've got no capital requirements because you're assuming you're making profit from day one, from month one. So that's where it might differ from a startup. But now let's say we got a startup in here, $10 million. Oop. $10 million right off the bat. Costs are starting, let's say, in March. You got costs starting in March. This is obviously January. Marketing right off the bat. Sales tax. You've got some upgrades. You already got that in there. And then let's say, well, we need $10 million now. Let's say we have no AEs for the first 4 months. And then they're 0% effective in the first quarter. There we go. Now we got some capital requirement, 11 million. Now let's say we want to finance, so we need 11. Let's say we finance 6 million in the leverage scenario. So in that case, we've now got 6 million. We still need to secure 6.2 million more dollars to fund what we plan on doing. And then we can see the back end of it, what we plan on that cash flow being able to do. So you put in this or this, and this is what you get out of it. That's the main thing people want to see, is what you put in, what does it create. And that's a lot of the valuation helps to deal with that. The running cash positions help show that. Revenue per AE helps to show that. And then obviously P&L, accumulated cash. And then this really helps to show it. This one's here is the best if you're trying to show leveraged positions. Alright, well, I guess I've talked enough. I think I've conveyed the best points of this model and how you can use it, play around with it to really make it work for, you know, your projection, what you're trying to show investors or yourself, really, about your planned business. Alright, so that's it. Now I have, so a couple updates. On smarthelping.com, I have adjusted a lot of the models down to $45. A lot of the industry-based ones now, too. So I think I've only got actually 4 upper tiers, and then I've got like 30-something mid-levels. I'm going to put this at a mid-level, at least for now. So $45 one-time fee is all you got to pay, and I'll send you over this template that I just built. You know, it's got a good, I'd say at least 15 hours on it, and it encompasses all of the major things I've learned in financial modeling over the years, and it's culminated in every single model I do is always better than the last, and this is the most recent one. And I wouldn't say always better than the last, because sometimes the logic usually differs. But the overview, the break-even evaluation, the charts, I try to always make better. The AE logic, I've really gone the distance in trying to allow you to extrapolate really easily with the minimal point of touches. And same with operating cost, startup cost, and then you can really see on a monthly basis. And you can really use this for monthly quota tracking, quarterly tracking. You can see it's got quarter over quarter percentages here. These are negative since we didn't start till Q3 of 18. And then same with the annual. So you can really use this model once you've projected what you plan on doing. You can use this to track, if you're on target and what you got to do from a bottom-up point of view in order to accomplish, your goals. And then after the end of things, you can kind of see what you plan on doing, how much it's going to generate, what it's worth, etc. over a 5-year period. All right, that's it. And again, to actually buy it, you go to the link in the description box below. YouTube, it'll take you to smarthelping.com. It'll take you to the page that explains this in text version. And all you gotta do is just pay in PayPal, and I'll receive the payment and send you over the template. And as simple as that. Any work I do to, as long as it's not an error, if I'm doing any work to go beyond the scope of what I've already done, I just charge $50 an hour. And obviously we would discuss that beforehand and move on it. Alright, that's all I got. Have a great Saturday. I just spent mine working, so you do the same, and I'll see you later.